Welcome to The Nest Show, the podcast that brings you insights into the crypto market, trading and investment experiences, and what we're looking forward to as we navigate the space together. Before we get started with the show, I want to thank our friends and sponsors over at Prime XBT, where many of our listeners have already signed up to trade by visiting the birbnest.com/PrimeXBT. Now, we're excited to reward you with a very special offer brought to you by our friends at Prime. Visit the announcement channel on our Discord to learn how you can receive a one-time trading bonus equal to 50% of your deposit amount. Exciting times indeed. Prime XBT is the most powerful trading platform offering immediate access to over 30 assets. Users may trade cryptocurrencies, forex, commodities, stock indices, and much more, all from a single Bitcoin-settled account. Prime XBT gives experienced traders up to 100x leverage to multiply their capital, while also providing users with multiple order types, low trading fees, and ultra-high liquidity to equip them with a one-of-a-kind trading experience. Registration does not require any user information, so visit the link below and start trading on Prime XBT in minutes. You'll be hearing much more about Prime XBT here and why we're so excited about the products they already offer, including a one-of-a-kind BTC and Ethereum options trading platform called Turbo, and an upcoming co-vesting product that will give traders and investors alike an entirely unique opportunity to multiply their capital. We're excited to congratulate the Prime XBT team on a couple of project milestones, starting with the launch of direct crypto purchases with the use of credit and debit cards. To learn more about how to purchase crypto on the Prime XBT platform using debit or credit cards, visit Prime XBT today for a complete walkthrough. Also, we want to regard Prime for their progress integrating TradingView chart technology into their charting platform, and their continued progress with the co-vesting module that will allow traders to mirror the activity of other traders. To find out more about the extensive progress of the co-vesting build-out, visit the Prime XBT blog for the most up-to-date information. And now for the show. Today, we are excited to be joined by Arun Chopra, founder and chief market technician at Fusion Point Capital, a market guidance and active investing service. He began his professional experience as a research analyst in the biotech sector, focusing on mid and late stage companies. Arun transitioned to wealth management prior to the financial crisis, specializing in portfolio construction and hedging solutions, with a special emphasis on alternative investments. His work has been published in the MTA's Technically Speaking, and he is a featured contributor to StockWits, where Arun has been ranked among the top technical traders. In today's episode, Adrian and I discuss many macroeconomic elements with Arun, and to put it bluntly, I am utterly blown away by Arun's expertise. We learn how Arun became a mentor of sorts to Adrian in his charting journey, and how his work at Fusion Point Capital can serve our listeners in their trading journeys today. Today is an information-packed episode, and you will not want to miss this installment of The Nest Show. Thank you for joining us, and enjoy the ride. What The Nest Show is. This is a podcast brought to you by the Birb Nest community, an independent crypto and forex-centered trading community built to sharpen each other in capturing opportunities in the markets while protecting capital along the way. What this is not: trading advice. We are not financial advisors, and you should not regard any information here or in the Nest Club as financial advice. You should always consult a licensed financial advisor before making any financial decisions. All right, folks, welcome to the Nest Show, and today we have a very special episode joined by Arun from Fusion Capital. Arun, how are you, man?
Good, man. How's it going?
I'm doing very well. Very excited to have you on. As I mentioned pre-show, I was checking out your body of work, and I got to say, our listeners and viewers, I encourage you highly to check over to fusionpointcapital.com and make sure that you see this man's work, because it truly speaks for itself. And we are so lucky to have you on. And Adrian CryPTOBIRB himself, what's going on, brother?
Oh, great. Thank you. And well, I'm so much excited for this very episode of the Nest Show, because I've been a huge, if not the hugest fan of Arun, since the day I actually just follow him on Twitter. And there's so much I learned already, and there's so much I actually, gained from this friendship. So I'm definitely looking forward, and just let's get it on.
And I want to make sure that we harness the time effectively, because Arun has a wealth of expertise and perspective to add to this current moment, which is in the global, political and economic sphere is somewhat unprecedented. So we've got plenty to discuss. But before we get into it, the present moment is nothing without a little historical context. So, Adrian, how did you first come across Arun's work, and what was your journey like connecting with him?
Oh, to start with, that's a very good question, because I think it was already couple of good months, I cannot recall the exact day, but this was certainly, I think it was around a year, because I actually had Arun to an extent be my somewhat like a guide, for my starting the journey towards the official CMT Chartered Market Technician designation and certification. I'm very proud of having passed, my very first designation level back in December. And just as I actually said pre-show as well, if it hadn't been for the coronavirus and all the delays, that the world stopped, I would have already been most likely the CMT2, the second grade designation, which is more like a halfway, towards the entire designation. I would have already been that in June, right? Like a month ago. But I'm not. This is all been delayed. But Arun would always have this special place on my feed. I'm like, this is most likely one of the only people I truly look up to, have my notifications on. So for anybody listening to that, there is no way, I swear to God, there is no way you can leave this podcast without giving a follow to Arun. There's so much help, Arun, you actually provided me with so far. I'm so impressed with so many works of yours, and with the quality of your overall market reading. That's so amazing for you having both the CMET, the CFA, and all the behavioral aspects to your analysis. I'm so much looking forward to hearing all your thoughts and charts about these.
Yeah, thanks. That's honestly, it's always nice to hear. And when we met, I mean, frankly, your work reminds me a lot of the stuff that I was doing, even when I started. Like, I get the feeling also of like wanting to do level 1, level 2 right away, right? So I know this pandemic kind of slows that. But I would say also that, like, frankly, I did my CMT, after I had been charting for a long time. And you can see it in your work, there's a passion, right? And you're sharing what you see and you believe in it, and you have the notes. And really that's, I think, a lot of people reach out and I'm happy to direct them in certain ways, but it's not that everybody follows through is one thing, and it's not that everyone should. It's my journey is very unique, and my history, I'm still relatively young. I started very young, and the behavioral thing came along on its own. There was times I needed fundamentals. There was times it was technicals. It's that organic journey that you don't just have overnight, or everybody has or should. So I think, you can see it in your stuff. You're teaching, you're showing, it's clear. I think all of that is, organic, right? It's not forced. And so whether it's level 2 this summer or it's later in the year, it's really not, in the big picture, I don't think it'll matter for you. And, it's really about, look at what you guys are doing. Look how much you're building. This stuff. One of the things I thought was so interesting too, in terms of crypto and even coming on today, was just in general, was like, dude, we didn't have this back then. Even 10 years, let's say, we just didn't have a crypto market that was liquid, that you could apply technicals, and in my group, people wouldn't know what to do with that anyways, because it's more, the foundation of finance, trying to apply that to crypto. It just doesn't really, you can have your narratives around what it is. That's different than price. And so it's just unique to see. I'm happy to be a part of it, and I kind of dip in and out of the market every now and then, but it is a huge piece of everything I watch as well.
Arun, I have to follow up and say that I'm just fascinated by your journey and how you got to become the founder and chief market technician of Fusion Point Capital. So you started up as a research analyst in the biotech sector. So what was it like? As a research analyst there, you were looking at basically you're finding alpha in biotech, yielding investment opportunities for. Was that for a family desk or for?
Yeah, sorry. So I should actually take a step back too from that even prior. So the biotech research ended up being the catalyst, I think, for me that led to like, the next step, like CFA stuff and wealth management and those. But it was built out of, and part of this comes through my feed, hopefully. But I grew up sort of in the .com thing, and I'm from NorCal, and I'd seen it all firsthand, and that was my big sort of exposure to finance, the good and the bad. And I think that piece of it at that age, and you're seeing it too, whether it be volatility in crypto or whether it be, frankly, the virus, right? I mean, you see it now, and there's probably people who are just starting out, and you're not supposed to know everything. As that led me to biotech, ironically, that position ended up being something that I couldn't stick with because we just didn't do enough capital market. There was a lot of market research on pipelines, on I had a general business background, but I had been in trading for my college time, et cetera. Anyways, we just didn't tie things to the financial market the way I wanted. And I remember, my boss at the time, who was actually a friend, was just like, this probably isn't for you. He actually was the one that said, have you heard of the CFA? And I thought, there's no way I could pass that. I had kind of heard about it. And frankly, I did not even do it for another 3-4 years. But I took an intermission, made a film with my brother in New York. Like, there was a lot of different things we were doing, but all of that was absorbing. And I think the bio piece helped me, at least, to some extent. It gives you the 10K work, it gives you the pipeline work. It's also very visionary. And if you think back to then versus now, the genome was just being mapped. There's stocks today like Illumina that were barely on the radar. And there's stuff in the .com stuff that, were theories back then that were bubble stocks for sure, but that actually are real today. Like if you were to apply a pandemic back then, you wouldn't have food delivered to every household the way it is now, So anyways, I think that's the arc of it. And the entry level into bio was a good opportunity to say, okay, wait a minute. Like there would be charts of silver. Literally, I was buying bags of silver back then, in that first bull. And so it was a good experience in terms of, okay, this is how things kind of work. But you could see quickly that, okay, you're going to be basically a specialist in pipelines of individual biotechs. That's not going to, for me, fill in the blanks of what I wanted to do. And so then that leads you down the road of, okay, and along the way, you pick up a lot of behavioral stuff. You see it in yourself, right? In the .com bubble, you're bullish. Then there's a real bear market. I would argue a lot of the younger generation hasn't felt a bear like 2000. Everyone kind of understands '08. You can feel a virus panic. You can see even vol in Bitcoin, but the '08 bear market is a different animal that we really haven't seen. And that's where you learn a lot about psychology and sticking with stocks that aren't working, or panicking or breaking finally after, 2 years of torture, things like that. It's all part of the journey, and biotech was a nice place to kind of, okay, get a little sort of foundational stuff and then kind of go from there. And so, Fusion Point came out only because at the end of the day, I just saw this is kind of what we're at now, building algos and tools and things, because that's the experience that I have.
I got to ask before we move on, this is just burning a hole in my head. You can't say NorCal and biotech without, speaking a little bit about the now infamous Theranos company that's been defunct. I know that you had moved on from the space while all that was shaking down, but did you still have ears to the ground or people in your community who were speaking with you about it? Did you see any flags early on, or what was your take on that as it was happening?
Yeah, definitely. I mean, it sticks with you. So like the .com bubble. So this is like, my feed is nowadays more contrarian, and I try to kind of push back on a lot of the standard stuff that's out there, even though a lot of it is true. There's no debate about fraud. There's no debate about the system being a boom and bust system. I don't think there's any debate about currency and all these things. It's just a question of how does it express itself over time in the market in a 3-month, 6-month, 5-year, 10-year, 20-year. And I think that's where, so for me, you never lose this idea after, especially the .com. There were so many, the .com showed you they would try to, selling an idea is nothing new, or extrapolating into the future and trying to give you, get you into the stock or whatever is nothing new. It was insane in the late 90s because there was nobody checking on these things. If you could get your hands on research reports from back then, you would find projections that probably you don't even see today in some of the more ludicrous stuff that's there. And so that cycle of behavior, it doesn't disappear from you once you've been through it. And in this area, it's nothing new to see fraud inside of innovation, particularly when money's easy, because it's an easy thing to sell and it's fast, you know? And even if your intentions were good to start with or whatever. So the Theranos building is up the road, and that was there, you know, before, like I think the Wall Street Journal had a building behind it when they used to do the print copies everywhere. That whole area up on the hill is, you know, you do have Tibco is there, many companies that made it. But then there's also this stuff, and it's more so than like anyone telling me. You immediately see, okay, this is BS. Now, I have family in healthcare, so it was obvious with one dinner to be like, can you really prick your finger and figure this stuff out? No, of course not. Right? So then you go to, well, is it possible over time? Does it make sense with the story? But then even in that, you know, you're dealing with a psychology that, look at the people that were invested big, huge names in the government, huge names in the country, right? So you're battling that, right? So yes, the short answer, yes. The bigger answer is I think these things are always there, and it just, being from here helped see it, but no matter what, once you've seen it, that's part of you now. I don't think you can blanketly apply it. And even when you see it, it doesn't mean it's going to play out the way you think. And that's, you know, the complicating part.
This somehow corresponds, you know, with one of the questions that I also have had, you know, them burning on my end. Because, you know, this is somewhat of a similar time, you know, to the dot-com bubble to an extent, right? Because we are talking about actual recession, the economic recession. And I'm super curious to know what's your commentary over the past months of the overall economic performance since the actual market, you know, top crash in February, March. Like, what's your take on that?
I look at it as, I think this is also where the distinctions kind of come in, because, you know, in January, February coming in, we had news of like the virus in general in December in China and things like that. There were people on Twitter that were making a lot of noise about it that ended up being right, but I would argue some have made noise about everything, right? So that's one thing. At the flip side, if you really listen, there's somebody I follow that probably bearish on everything, and I dismiss a lot of it, but that I listened to, and they did nail it. They nailed it. But so it's kind of like the logical flow. Is this real? Could this happen? I did a video on Italy a week before, and not to say I told you so, to say this is logically, was likely to happen, right?
But you told them so.
yeah. Well, I did. Yeah, sure. I told them so. But yeah, and I think the big thig was, even then you don't know how it's going to play out in the market, and that's a big piece of it. You know, you could be totally wrong and be right in the market. I think the bigger issue was, as this was building, in terms of the stuff I follow, and that's why I put a post out in February. That's why I lightened up. You could see TLT breaking out. You know, there was enough noise there to say, okay, we're well off I think it stemmed from the 19 low, right? In 2019, you know, when we had the low, or came out of 2018, I should say, and came out of that rally, we got frothy towards Q4 of 2019. So it was already a risky market. The pandemic hits, and you could see something no one had seen, right? Shutting down things. And that piece caused, but I think the problem, especially at the low, and I had how many algo signals and all that stuff, was this, I think there's a knee jerk to go back to 08 or go back to 2000, right? And because of that, you end up in a situation where you just can't foresee the Fed going to zero, unlimited, you know, 20% increase in M2. You talk about, you know, backstopping now corporate bonds even to an extent. When you do all that, who could see that, wait a minute, let me go to the fastest growing names, you know, in the market, that it might be $2 to $5 billion tech stocks, you know, or it might be a Google or whatever. So to me, what's happening in terms of the market, it does make sense from a volatility standpoint, from a easy money standpoint with a fast acting Fed. I think when you get to that point, you start to say, you know, it's an example of trying to fit old, you know, scenarios onto something that is totally new. And it really takes that person thinking, wait a minute, this is a pandemic. Everyone's, you know, maybe not work from home, but money's getting cheap, and we're going to have this crazy V type of thing. You know, that to me is the missing piece a lot of people don't want to even think is possible.
That's very interesting. That's very interesting because it actually, well, if you think about it, well, to the best of my understanding of how markets work, the actual economic recession did start at the time that you mentioned, the actual, you know, break, you know, between 18 and 19, and all the entire 19 was more of like a more like connected with growing inflation over the, printing money, endless printing money. Is that correct to an extent?
Yeah. I think one of the big changes, so people always say, and I see this with people who are more my generation in terms of like the finance equity side, the big conversation is, the Fed being out of bullets, or this idea of being stuck in a market that the Fed can't help. And that is a very real thing. I've been there, and most people can't understand that unless you've been there and been stuck. And by that, I mean, I think it was a 75 basis point intra-meeting cut by Bernanke in the 2000 cycle, I believe, or maybe Greenspan. I can't remember, but there's a 75 basis point cut as tech is deflating, and they're trying to somehow save the market, but there's just no way with the way monetary lag works that it's going to work. And so you're trapped. You maybe have a 2-day bounce to lighten up, and we're going lower over the next 3 months. And that's like a grinding bear. And you also don't really want to sell because you're remembering that these stocks were, insanely momentum for a decade, not just the last 2 years of the 90s. So that thing is a very dangerous component, but people forget that was also created by the Fed. They had raised rates all of 99. They had really taken liquidity out. And so generally in those scenarios, the liquidity gets pulled. The markets continue to hold in. You see deterioration in certain stocks. The real economy is already in recession. And eventually that is the traditional model that we all understand that, I think everyone's trying to find again. And you could make the case that out of 19, yes, that we were starting to recede in the real economy in Q3, let's say, of 19, right?
Yeah.
That I think that's fair. I think we never got to find out if the Fed made it in time because they did stop tapering in 18, right? They did pull back. In fact, my biggest shorts were all mid 18 and they were taking forever because the Fed had started tapering the year before, right? So I think it's fair to say, I just think we'll never know.
That's crazy. That's crazy. I mean, that flowing actually, from so much knowledge of yours, it's very good to know that I at least, have some good portion of understanding of how it works to an extent.
I think you're right. I think imagine if there was no pandemic. Would what they had done in mid-18 been enough? And there's a fair case to say no, it's not. It's just very hard when they're sitting at zero. We just don't know. I've seen good cases on, the Fed doesn't need to raise to cause a recession. Sure. It's much harder than it would be, and we don't know how hard, right? We just, the difference between 2% and 0 is a massive amount in terms of interest, so we'll see. But I think you're on the, I think it's a right story. I wouldn't say that that's, false. No.
I got it. Just a very quick part though. There was the second part of the question that I'm actually even more intrigued by, because what we have been seeing, since the actual crash in February and March, I think this is an unprecedented event on the global scale, like in economic history, right? Because one thing is top global economists that would say, real negative interest will never work, but they actually all of a sudden work. Yeah, but isn't that this entire, I would say, just rally past since the crash in March or February, isn't that somewhat of a dead count bounce only?
So I looked at this actually. I'll give you an example of '08 versus now. And then I think that the bigger qualifier being that this in and of itself is not a reason to say, no, it's not. I think there's you can we could all talk about the divergences we know, whether it's financials or casinos or airlines or whatever. This week you see autos getting back into play, plenty of chemical stock, XLBs rallying. So that I think is always a moving target, right? It starts out potentially as one, it might not turn into one. You'll never fully know. But we could look at like '08, and in the summer of, when Bear went down in March of '08, volatility spiked. It was a headline, but it went to the back pages pretty quick. And if you really look at the top in '07, you see almost about an 18-month rounding out sort of process. During that time, the internals had diverged. A lot of things had happened prior to the bounce in March of '08. And one of the things I try to focus on is if you're looking for what is the example of the current market, is this a dead cat? Know that it can change on you, even if you've got it. Like you've got it, you saw it, you see the divergence or whatever, it can change on you pretty quickly. Especially in this type of environment where the Fed is after it, and right. So that's one. And the second thing is, where did you come from prior to that bounce? And you really have to analyze. And traditionally, '07 was a big rounded top, lots of divergences, big money was out. The bounce in March I remember the headlines on Bear, and I remember a lot of people not paying a lot of attention. In fact, I was talking to my boss at the time. We were just laughing about how, isn't this crazy that, this is now happening, and this always happens when they lend long, they're borrowing short term, lending long, all these things, but it went away. That summer, bullishness spiked to 52% in June and July of '08. The market never recovered. In fact, breadth had stayed negative the whole summer. Breadth, for instance, today I've seen readings as high as 70 and 80. That thing got stuck at 48 all summer, the same gauge, right? So it's sitting at 48 all summer. Suddenly everybody's bearish again, and then Lehman hits, and even then Lehman hits almost 5 months later, right? So this is the nature of cycles and markets and psychology, is that it's designed to kind of wring everybody out, designed to make everybody look at gold, right? Gold is now moving higher, but after the initial pattern, it went nowhere since April. And most call buyers probably lost the premium before it really ran. So in a microcosm, I would say that '08 is a classic bear. There's plenty in '00. And I think in this environment, yeah, I'm not buying something at 60 times sales. I never will. But at the same time, the internal piece of this is a little bit, at least we can qualify it as, look at the bearish. Could you imagine 50% bulls right now? It just wouldn't happen. It's not part of our lexicon today. So I think anybody who claims it to be one undeniably would have to prove that a little bit more. And anyone who says there's no way it is, that's kind of the problem too, because then you're adopting a market that has really diverged, right? In a way that doesn't make a ton of sense.
It's very tricky. It's very tricky. I completely agree with that, Arun.
Arun, following up on your statement there with gold about gold being, kind of a laggard to shake out a good portion of retail. What would you say is the bull case and bull timeline, possibly, if I may be so bold as to ask, for Bitcoin? Because I know that throughout this market and the uncertainty with the with the dollar and with oversold commodities, or rather legacy markets. People are, a lot of the faithful are really kind of waiting for Bitcoin to emerge as a kind of new wave hedge. And I just love to hear, what the bull case that you would see for that.
Yeah. I think structurally, I should qualify all this by saying that, I am on the team of sort of, this decentralization and sort of this accountability within finance. I think part of the problem is we were talking just in terms of, meeting and Twitter and everything. I only came to Twitter, I want to say 3 or 4 years ago. I used to post a lot on StockTwits as well, which is obviously, lesser known in terms of, I wouldn't have met certain people, but I love the platform. I had been there for a while. And so anyways, having done all that, that world has been very anti-equity. And so my prior to this bull market was all precious metals. Most people don't know a ton about that dollar bear market from '04, really 2001 to about '07, really before the finance. There was about a 6-7 year real bear market in the dollar. I think we broke below 70 and hit 60. And that's when silver, of course, hit 50 and all that other stuff. And so I think within that, as a foundation, I used to ghostwrite under a different name or whatever, and I want to publish it in some time days because it was so bullish, these metals. I think that trend doesn't stop, obviously, but I think Bitcoin in many ways priced a lot of that and then a lot of euphoria too, right, when it got to 20. I have a kind of a rule of 3 where you see 3 things happen in a row. The third one usually fails in market. So the idea of 3 breakouts in a row, whether it's 2011, whether it's now, or whether it was 2017 or now, but those are more technical things. I think the bigger issue is more about, which I haven't looked enough at, but it's more about adoption, I think. And, there's so many coins, right? So let's say someone like me that is kind of more of a generalist, there's so many. How do you figure that universe to a point? And I think the underlying bull scenario, waking up to a shift in what currency really is supposed to be, right? That doesn't go away. Who benefits entirely from that has always been, you see people saying Bitcoin or gold or silver or maybe some ether, right? There's plenty of ways to play it. I think I would say that it's more of the question will become how much of the 17 overhang is done with. And that may be answered pretty soon here. I mean, the move to 13,000 got the same sentiment we saw at 20. And that was a while ago. That's shaking out. It's been an impressive hold above the levels, and look at it this way. If Bitcoin were to range between $3,000 and $20,000 over the next, I don't know how long, that would still be a massive win given where it's coming from, right? I think, the inside of the volatility of that range is still magnitudes higher than it ever was, in 2011 or anything like that. But I think it's still a very open question how the currency system is going to, shake out. And this printing is one thing. I've seen it how many times. Look at even PPP loans or anything like that. Who gets the capital? Who puts it to work? Where does it go? It's not as easy to print and hand money to everybody as certain prices in alternatives could presume at times, right? I don't know if that's what's happening now. And it doesn't suspect me that silver moving to 24 is a sign that the whole system's collapsing. I mean, there's room, right? There's room. But, where do you get the dollar? You get it down to 60 in the next 2 or 3 years. That's a tough road, I think, given the way the currency system currently is. But is it in the longer run something real? Yeah, you can pin a lot of the social stuff in the world without a virus to the lack of, accountable currency. That's not a stretch. I don't think that's anything new. But I think there becomes an issue of, okay, then do you run to the financial asset you think represents that and buy it at any price? Yes, if you have a long horizon, but if you're saying, oh, it's going to break out above 10 tomorrow and run, you got to watch the tape. You've got to know.
Are there any, I guess, macro scenarios that you're anticipating where you're like, you know what, this is really going to be the test for Bitcoin's emergence, whether or not it really sails, as emerging countries and central banks fail with, hyperinflation, et cetera. Is there a scenario like that you're thinking, okay, this would be a prime time for BTC to show up, or if it doesn't really show up here, then maybe the great experiment is all for naught,
Right. Well, and what's interesting about that though is like I could say, well, because it didn't move now in the face of all of this Fed interaction, therefore it's not representative. But knowing historically cycles in general, I don't think that's a fair thing. I think the fact that it's back in the 9s and 10s even post, if you look, it did liquidate with the rest of the market on the initial panic, right? Because deflation, the dollar, et cetera. They come in and do swaps and everything else, and you see these things bounce back. I think on some level, even if you're super pessimistic on crypto or Bitcoin, let's say, as a thing, you can't deny that it's showing strength even in the face of maybe not as much as people would want, but in a real virus panic, why, you would think, well, Litecoin or Ether, these things would stay down, and they're not. I think the problem with the larger macro, having been around, how long has the Hong Kong dollar peg been going to break, or Japanese rate spike, or, those macro pieces. One thing that I think, at least, and I can't obviously prove it, but over the years, the Fed has gotten smarter in terms of what to pin in the financial market. Not that it's smarter for us overall or anything. I mean, it's an extension of how we got here. But you could go back 10 years ago, and if a macro event happened, transports would fall out of bed, or copper would collapse, or something like that. And you would see that as a tell, and it would work, because even the Fed, you could go back to 2007, there were things breaking in the market. The Fed had no idea. They just didn't know. They would say, oh, things are fine. How many comments were there prior to the financial crisis? And home builders have been diverging for almost 2 years, right? So I think a lot of our signals are kind of gone on the macro side. You see them, it's almost like, okay, this is weak, suddenly it's strong, and so I think they've gotten more smarter with that. And so more so than I think getting a signal from the market, it's are the fundamentals here. Like I often wonder, like I said, numerous coins, I think Bitcoin came under pressure when transaction costs were high, or like when a network kind of slow, something like that, versus when that gets corrected all of a sudden. So adoption probably plays a big role in this. I think those are the bigger signs, rather than saying every central bank is going to fail. They're going to fight, right? So, you can get paid in different ways along. Look at lumber's move, or palladium, even over the course of the last few years. So I don't know if the thesis goes away as much as it is. You have to look, these are things I don't know about the crypto market, but why is the dominance there? Does it stay there? Is it the medium of exchange? Does it become the major thing? And is it continuing to grow? because you do have the truth of, accountability and transparency, right? And so I think that is the real underlying bet, right? Is that's where, we know how societies erode. You can see the wealth disparity. These aren't new things, but I don't think that it'll be one specific, event. I would say that if crypto wasn't up here and holding up during this, to me, that would be more of a signal like, okay, maybe the system itself isn't, we're deflating, stocks are going to come in, et cetera. There's just not liquidity. As a liquid instrument, it seems like it's been holding as the superior one in the space for a while.
Thanks, Arun, for all the expansive, I guess, explanation, over the market, because, the way I can read all that you're saying is that you would consider all of the markets as a part of, as kind of like an integral unit, as a kind of like unity, right? So that the way that you are, discussing the markets, at least on my end, it does look like you consider that as an integrity. That Bitcoin, let's say, is not necessarily having this one impulse, let's say, this one short-term impulse that all of a sudden would make the world collapse or make the, just all the banks collapse, just the way you said, right? That it's more, first of all, about these huge long-term perspective and vision by observing the actual fundamental and intrinsic fields and actual intrinsic fundamental trends, I say. This is actually the way you should do this. You should practice this mastery over the equity market to an extent, right? Because this is what's different between the Bitcoin and the entire crypto industry when you compare that with the equity and the classical legacy markets. This is this intrinsic value that Bitcoin is actually lacking because of the decentralization. And my question is, if you were able to tell, like, apart from Bitcoin, perhaps, and perhaps you would be so kind to actually pull up some charts. What was the most surprising asset that you saw like performing the best that you would never expect, or like the asset that most surprised you since the actual pandemic started officially, right, in February and March? Is that possible for you to kind of like get over these?
One thing I wanted to show you guys, we were just talking about fusion point as well. We could add this or whatever, but I think one of the things I want to show you is if you look at like revenue growth stocks, and I posted this recently, and these are R&D, these are kind of healthcare names. These are just comparisons between them, and I'll just show you, like, the value names. We all know they've been down, and I've got a different set of value things, and even companies that are buying back shares at what I consider to be a reasonable rate, that hasn't gone anywhere. A lot of that is because capital is being preserved. But if you take this to a 36-month view, sorry, that's the 12. If you take it to the 36, you really can see, look at this incredible outperformance in these spots. And it really started during the during the COVID, during the virus. And so I guess the easy answer would be, I didn't expect to see revenue growth stocks really rally in this way. I don't think, I think my first inclination, and anybody, once you've gone through a couple bears, your first sort of thought is, cash rich if it's equity. They've got to be able to weather the storm. But if you look, even some of the stuff I track, like balance sheet type, stronger balance sheet companies, they really haven't done much. So I would almost invert that answer and first say I've been surprised that the balance sheet stuff really hasn't done well. I would say there's some surprise to the high beta, but at the same time, the Fed is at zero. So I think that's there. With respect to the equity markets holistically, I do think that's the right way to do it, because look, I was this way when I was first into silver, and I could literally buying 90% bags, right? And I think it was $750 was the price at the time, maybe $9. I was at the SF Gold show in like 2006 or something like that. And the point being that you can get to those places where you say, it's an either or. The banks collapse and Bitcoin shoots, but I think it's more complicated than that. And I also think that you will lose a lot of other like you want that in your matrix, right? You want that piece of that, but you want to be thinking also what else. I have a crazy story of a friend of mine who started a website that was a search thing. He turned it. They wasn't getting any traction. They turned it into a celebrity site. It was bought by Google within like 3 months or something. They closed it down. They paid them out.
Whoa.
Yeah, and get this, he's getting a 3-year payout, a decent amount up front. He calls me, and I'm doing wealth management at the time. He says, what should I do? And we were looking at standard thing, and he says, what do you think about Tesla? And I said, look, and at the time I said, I have no idea. I had just IPO'd. It was like $32 a share. And I said, I have no idea. It's not what I'm looking at. You know, it's speculative, I'm sure, et cetera. And we're just doing traditional stock bond stuff. Anyways, because of his age and everything else, he just went on his own. I believe he took half the lump sum, from my understanding, and went straight into Tesla. I have no idea. Here's the irony: is he probably sold it, you know, at like $80, right, or $100 or $200, right? You know. But my larger point is, I think there's a lot of ways to think about wealth and innovation and things in the context of a screwed up, you know, system. And that's a lot of like, okay, that the money side is the unit of account, right? It's the means of you know, this is how we're accounting for things or trading value, but what is valuable underneath that can still be sort of done. I don't think that this is that. I don't think that seeing, you know, certain stocks, like if I were to go to, you know, the Rev list and just look at even technology, you'll just see, I'm sure a lot of people know these names. But, you know, you could see even in these smaller stages, you can, and if we just do it, even the fastest movers in the last, you know, it's a lot, Datadog is through the roof, you know, OKTA, sure. I don't know how surprised, but I don't think that is, I don't think it's sustainable. Yeah, I don't, you know, I don't. And other than that, I'll be honest, man, the biggest surprise was that we dropped a full 40% and the VIX hit 80. You know, I think anybody in, right? You know, 40 would have been the upper limit, 50. That was a surprise.
For what you were actually just showing, you know, on the charts, you know, with within these, let's say, stocks that were not necessarily 100% expected to go and perform so well. I'm actually, I cannot help myself, but I'm actually just having your tweet open. The one that I commented that it actually just sums up past months the best way. And there is this chart ratio, not even the ratio, but this comparison, you know, one chart put on the top of the other that compares Tesla with TSLA, right, sticker, and then you have like TLSA, right, so two-letter change, that is what Tiziana, like Life Sciences PLC, right? And it's so hilarious because their charts, I mean, they look brilliantly the same, right? This is so insane. I mean, correct me if I'm wrong, but to the best of my understanding, like with all this, you know, stimulus and all this, you know, just unlimited QE, could it be really the case that people would literally confuse the tickers?
Yeah. Well, I mean, it's funny how that came about because I had been, you know, obviously just typing in Tesla one day. I think I typed in the wrong order, you know, and so it had been on my screen and I was like, oh yeah. Anyways, and I noticed that it started ripping recently and I was just curious. I'm like, I wonder what the return on these two is just specifically since the low. And I think you see that because there's another one, right? There's like a Zoom, or there's like Zoom info, right? ZI, and it has come down a lot now, but at one point it was running. And actually there are academic studies. Now, so these are two separate issues, but you could combine them in the same behavioral phenomenon. But there is a lot of studies that show that catchy types of names, and how you would study this is debatable, but there's catchy types of names that do outperform. And so whether that's like a name like Zoom, a ticker symbol like Datadog, right? You know, and obviously this one's just been up, but something that we actually experimented with, like finding every 4-letter thing that is kind of something you know of, you know, or catchy. And so I think that also leads into these moments where, yeah, like people don't know they're buying. I don't think people actively think they're buying Tesla, right? But I think there's some component of like, yeah, I mean, this sounds like what's running, or this looks like what's running, or
this sounds as if it was a good runner, right? Let's get it.
I tweeted that yesterday, that joke kind of about somebody calling me and saying, hey, what do you think of this stock? And then me kind of going through the numbers and then them saying, cool, I'm already in it, and it takes off. And that actually is happening. I mean, I am having, yeah, that does happen. People ask me about, oh, what do you think of this name? And it's like, okay, I mean, those observations aren't super relevant in what's now become for the last 4 months. It is a question of your own individual risk, and that's a whole bigger bigger thing. But in terms of the way the markets are moving, it is, I don't know if there's a word for it, but in some way it's rationally, irrational or whatever, given our history, given what we're doing now. I didn't catch the low because I was thinking about things in terms of how the pandemic would affect society today or the economy today, and really not even how it would affect it tomorrow. Now you have to start asking those questions. But back then, it was, okay, well, everything's beaten up. The Fed is an unlimited QE, and certainly then you see this. I just don't think that TLSA is necessarily the sign that it's a bear rally either, right? I don't know. But I know I wouldn't be buying it, and I know we're seeing those extremes, and I think that speaks even more and more to the conventional wisdom that thinks all this stuff is mathematically or logically sound. It's often not.
Our listeners are anything like me. They're deeply impressed with what they've heard from you so far, Arun. I am just chomping at the bit to learn more about what you're doing at Fusion Point Capital and how myself and our listeners can work with you over there.
Yeah, totally. Thanks, and I appreciate that. I mean, I like I said, this stuff came about through, it's really organic, and so I'll just give you a kind of example. Is I do an active thing where we have like a chat and stuff, and I put out what I'm thinking. I do videos. My sort of background of like biotech to wealth management to this stuff now, it kind of came about because I really, in the wealth management thing, it's fine, and I understand the need for it, and I'm always impressed. I'll say this now because I know some people follow me, they don't know all my views, but I'm very impressed with good in particular, but like prudent financial advisors, people who really understand sort of the wealth preservation piece, the growth piece, the planning. This is not an economy that makes sense for most people, and I don't expect that to change. If anything, it's gotten worse since I used to think it can't get worse. So I think that those roles are very important, and I think you can express your financial values through that process, wealth management, preservation, planning, under the knowledge that this is a broken system. And so that's first and foremost. But for me, I certainly moved away from it because it was not as exciting. And, when markets were going straight up too, there's less of a premium put on someone, frankly, with my background, I would say. I mean, I think it just becomes a buy and hold sort of world. This whole Fusion Point thing was stuff I was trying out when I was learning. And what happened is, the technology changed. So access to quantitative fundamental data that you just couldn't get. The algo, which I post a lot and is now live, and it's still, it's available, people can buy it or whatever, but like it's still, I have to run it and manually look at it. I tried to build that with a well-known hedge fund, but we couldn't get the data back then. So I'm doing it all in-house now. This stuff is basically a way to look at common things like growth, quality, and value stocks, but break it down even more. So, I've got things that are like revenue growth only. So it doesn't have to have profits, and stocks like Shopify connotate that. We kind of broke down all the factors, and these are other stuff like short squeezes or things I learned over the years. I'll give you an example like R&D, companies putting money into R&D at a heavy clip tends to lead to future returns. These stocks have had a great move this time, and I can show you even if you just go to like, I don't know, we'll go to healthcare and bio and tech, and you can see in the small cap space in particular, and you just say, okay, like, I don't know, some momentum on it, maybe the 60. You start to see stuff like an alarm or whatever, but there's also a lot of, healthcare, EBS or things like that. So anyways, this is a way for me to isolate fundamental factors and then visually kind of make a decision. And there is value things you can put on top, but the point being, I came to a place where it was not necessarily about, each spreadsheet. And I think we can combine factors with charts. It's worked well in terms of, I found things I would have never found, in the past because the computer can seek it out. So this is new. This is literally, I used to run this with another software. Now we have our own, and this is pretty much done. It was built in the last year. And so there's stuff on this, and then I work privately with people too. The algo and the scans are really where I want to go, because those are the tools I use. And I think that those encompass not only behavioral and the algo and capitulation, but then particularly for swing, but also if you're investing, there's ways to find stuff. But for me, it's just changed into a world of, these are my most scalable businesses, and I can visually see them, in any time frame I want. This is kind of how I operate day to day. and I can see things, I can see what's short, etc. But it's really the back end of how, I basically go from, I do need to know, does this fit a fundamental bucket? I can do more work after the fact, but my decisions are usually first done after that through filtering through the visuals, so and that's ultimately, we're doing research for advisors, I'm running, videos and things for people who are of all stripes. But for me, that's been more enjoyable, frankly, and of course my trading, it's just a little bit better than the pure wealth management. And frankly, this stuff didn't exist. As I said, I couldn't pull this type of data in the past and line it up this way. And so, yeah, that's Fusion is designed to be components of fundamentals, technicals, and then definitely behavior, right? I mean, behavior, which can kind of fall under the technical umbrella, but it has its own, and that's why we're doing a lot more surveys now and things like that. But frankly, the algo tends to pick up, enough of where you start to see imbalances because of people's, frankly, just, behavior.
So today we're seeing, an uptick of, day traders and kind of a retail army led by Dave Portnoy and, the Twitterverse of, folks who think basically are filling the time that they would be spending at a, 9-to-5 job. They're at home and, they're trading and to whatever degree of success, with Fusion Capital and your, or rather with Fusion Point Capital and your offering here, with your monthly subscriptions, who is your key demo and who would you say can benefit most from this various suite of services? You have Fusion Active, Fusion Scans, Fusion Algo. Who are the big ticket purchasers here?
Yeah, so it's interesting. Like part of this was, doing research in general. It's interesting to see the way this has changed because I didn't understand that, so many people had done these paid rooms for crypto and things like that. As you mentioned, Portnoy and that phenomenon, I think it's only a bigger extension of everything. Like if you were to go back 20 years and say, if the Fed keeps doing this and if we keep this sort of bubble boom bust thing, where will we be with 20 somethings in 2020? And you could probably draw, outside of the virus, you could draw some sort of line to Wall Street bets and mass speculation. I don't think that is too far removed. Now, it doesn't mean that it's right or wrong for the moment. I think in the big picture, we know how what that does. We don't want everybody in finance, right? Or in particularly in trading. But I think that whole thing, what I've seen is especially people that have had success. Part of my thought was, well, go ahead and build this because I'm using it. And also, rather than just say, okay, this is my research piece on a couple stocks or I've done a deep dive, the world's moving. And I have found actually crypto traders adapt to this the best, and technical traders too, because it's like, okay, look, you don't need to dig into the numbers. I'm just telling you that we've done the work on that side. And this comes down to like at any given time, a couple hundred stocks. And, if you have a real technical bend, I could just go through, I think I posted this live, but MSCI is a really good example of a classic technical setup. This was at the 19 low, and I go to this one a lot because it had a false breakdown. It was on our scans fundamentally, and it just takes off technically. Now, the problem I would see with a lot of veterans with this is it was still expensive. It still is expensive. It's always been expensive. I paid 6 times sales, sold it at like 12 times. I think it got to 14. I've adapted my thinking on that. So I've seen people who are more crypto driven kind of not have an issue because that doesn't necessarily come into the matrix, and they're able to adapt quickly to, okay, that's a chart I like. Okay, I might do a little fundamental stuff or whatever. It's all here, right? You could do it. But at the end of the day, there's that. I think on the active side, the videos, it's a mix. It's people who are trading. It's also, I like to tailor like once a month videos for advisors, this type of stuff, the outlook thing, because that still is near and dear. The algo is much more for people who already have an existing trading approach. So I kind of try to caution, like if you don't have one, it's a counter trend system. We're trying to build in some stuff where we can say, okay, I get a couple hundred signals a week. Which ones have some form of confirmation? Have they turned the corner yet? You could make a technical condition for that. But right now it's mostly like, okay, if you have been trading and you want to get a sense of what's capitulating and you know what you would do with a certain chart, then that's the sweet spot for that group right now. We may try to make that easier, but that's where, because counter trend has its own risk, right? Even like Zoom, right? It can come off $50 and still end up $100 higher in 3 months. At the same time, some of these bottoming ones are just incredible. I mean, if you go back to the 08 low, I mean, URI, some of these signals at the low on some of these, in here, Etsy and Align, I'll just show you. These are growth and quality names with all the factors that I like. And then you get an algo and it's through the roof. So it's that, and it's Align, and there's plenty. I mean, the whole system really, So that's kind of how it's structured, and we'll see. I think that part of this is trying to say, okay, I don't think advisors are going to come in and trade a chart, but I do think that, swing and position, this irons out a lot of the issues I've seen with just momentum or just value, and so that's it. We're just seeing how people transition. I will say I've seen crypto people do very well with this. Experience for the algo is helpful. And then in the active side, right now it's broad. It's getting a little crowded, so I don't know if I'll change that, but it's broad. You got people who are just learning, to people who are managing a lot of money for other people, to people who are running their own portfolios, and so that, we'll see. My bigger thing was build what you can, right? Rather than say, here's how things have been done. And then it's cool because in a time like this, although the revenue growth stocks are doing well, there's other stuff in here. I can see the strategies now, and I can get a sense of what I'm trying to do. And my last piece on this, the largest overlying philosophy is no matter what, whether you're advising, whether you're a portfolio manager, whether you're learning to trade or trading, the only thing I know is that it takes work. And so the tools are there. And I've seen people under 30 who are not crypto, who are more traditional, let's say, I don't know, business school or something, be able to plug in very well too with the factors and understand them, and then overlay a technical thing. I think there's a less stigma now to technicals than there was. So we'll see. I mean, that's, it's a mixed group for sure, with my focus being like, okay, my first thought is not who is this for, because I use it, right? From there will come, okay, who's, best suited. But it's been fun to watch. It's definitely been fun to see. And I don't even think this dashboard came about through a collective process too, so we could, learn about each strategy.
Yeah, I definitely want to comment on that it's one of the most professional websites for traders I've ever seen on my end. With such amazing, just caretaker that Arun is. I'm quite sure, to be honest, okay? Right after this podcast, I'm making my way to this place. I can tell you, I can promise that. Yeah, but before we go, I mean, I want you to know, Arun, that your generosity, with your time today, your overall, I would say guidance for me. Well, I think this has had a lot of impact to kind of shaping the way I am today as the market analyst. So I always look up to whenever I see, be it be it a beautiful explanation of the chart or even a damn stupid fucking meme, whatever you do is just top quality, man. This is so insane. Yeah, but before I let you go, I do have this one. It can be more complex, but I think we don't need to make it the most expensive answer to that. But there is. TA itself, okay, is extremely controversial for the majority because, most of the people will never truly understand what it means, right? What it means, how you define it, how it works. For some people, you would just see some squiggle lines, over the chart, right? And they would say, how the fuck can chart listen to a simple stupid line that you draw, right? It doesn't make sense for the majority of people. But when you actually discover and gain the knowledge that stands behind it, then you actually realize that it's not a stupid line, okay? But it actually represents the behavioral finance to an extent, and all the actual amazing, I would say, studies that have been just pretty much on the table for years and for decades run, just over and then, just provided by such amazing people like you are. But for the question though, how, and for our listeners, how would you define or perceive, use, apply in general the combination of technical analysis and behavioral finance / economics? Yeah,
no, I think that's the big thing. And I think, like I said, you're more than welcome for the guidance. I mean, I've seen your stuff, so I feel as though these are, I'm not on some, crusade of okay, it's got to be technicals or fundamentals. I just think that over the years, we don't really open up to the benefits and negatives of each approach. And if you look historically, at how technicals came onto the scene, it was chart patterns, and I understand that as being like, how could this chart pattern, and that's true. But then if you look at some of the biggest pros, like Gunlock has moved into sentiment and resistance levels. That's a big thing. I think they've missed in many ways because there's some stuff missing there, but that's fine. If you look at Druckenmiller, I mean, essentially it's intramarket, right? It's how different sectors are moving and what that's telling us about the economy. And so I think that if you look at the hardcore value side, like Graham and Dodd being the original book on that, there's massive flaws with that. I mean, that book was written after the Depression. It's a bunker manual to not go broke, but it's not necessarily a manual for finding a winning investment. And it can be over time. I'm sure there's been back tests and things like that. And I think that Technicals has that problem where the original authoring stuff is all patterns. So I think that's the point, is to really find ways to communicate that and show that. And the way I have seen it work is there are concepts that I think everyone can gravitate to, whether that's accumulation, distribution, capitulation, trend and internals. And you start to move away from squiggly line at that point, right? And you start to look at it holistically. But it's not going to transfer for a lot of people no matter what. It's just not. I worked in a very value-driven wealth management sort of situation, and I, appreciate everybody there. I would never say anything other than that. But, even using a weekly moving average was not something that was, you can imagine a 30-week, 50-week moving average just to say, is this in an uptrend or a downtrend? That's the level of backlash towards like a pattern or a trend. And so the more you can shift to, because, and I see this, people see the algo results sometimes, I literally, the algo fired on, I did a video on March 23rd specifically to say that this whole thing is going to turn because of what I was seeing. And so even when you see that, it's still not easy to translate. Okay, so let's say I'm an advisor. How do I translate it? Or let's say I'm a trader with not a lot of experience, or, I believe in every book, how to price an asset. It's still not going to be usable. So part of this is trying to focus on the things that are most relevant to all of our minds. And again, I think that is stuff like, okay, this is being accumulated, or this looks like it's going into a mega cycle or something. That coupled with like a movement away from, okay, if this line just moves this, it's kind of like, what is this suggesting, right? And once you get there, you'll see that oftentimes asset prices are telling us the story. It might not be the story you want it told in a way, but look at today, work from home stocks versus airline stocks. It's telling us the story. I don't know which way it's going to conclude, right? I don't know. Do you short, sales growth names and buy airlines? I don't think so. Do you know where this economy is going? No, but we have a sense that how long airlines have is liquidity. We have a sense of what the government's going to try to do to save them, right? And all of that should filter through to the way prices are acting. So you should at the very least be able to tell a story that at least is the current one. I think the challenge then becomes what moves next, and that's the art, and that's where you start getting into, okay, these are my charts that I'm looking at, and it becomes a risk management tool at that point. But I think there's just a lot there between pattern analysis, intramarket behavior, and I almost want to, there was I forget his name, there was somebody, but they called it basically visual analysis, right? Was the name to try to change it to, or work on some component of tying in the behavior. Because I fully agree with you. At the end of the day, 90% of people will look at it and be like, oh, that's a squiggly line. And then the last comment on this is the screwed up thing is you don't get the leeway that a fundamental investor gets. So if a squiggly line is your narrative in someone's head and that line goes down, even though you thought it would go up, that's it, it's over. See, it doesn't work. If I tell you a fundamental story about a company and all this stuff that's happening, it could drop 90%, I can still tell you the story. And people will say, oh, okay, I get it, right? So I think those are the challenges. That's why I think, you've done a great job, frankly. Look at the way you're explaining, the patterns and what they suggest or what can come about. But you're never going to be able to fully do it because people will always say, oh, that you said this or you said that. And then the other side of it too is that it's just a more of a stigma thing versus being like, I pitched you a stock that is in the dumps for 5 years, but it's still reported earnings this quarter. I mean, that functionally has its issues too, but I think we just humanly look at it different.
Frankly speaking, okay, this is one of the best explanations for those who actually are learning and searching their ways into technical analysis. I think this is such a great summary on that. And I'm honored to I'm honored to have been your, you're somehow to an extent like a coachee, right? Although not even formalized, but you've always been like a great person to look up to, and I'm so happy for your being over here with us.
Guys, we've had a phenomenal show today, and it goes without saying that our listeners and everyone should hurry on over to fusionpointcapital.com and get a better initiation into the work of Arun and his team over there, because it's really impressive stuff. Arun, I want to just say that you've been a phenomenal guest and really appreciate you sharing with us today. And we're keen to give our guest the opportunity to leave our listeners with final thoughts. Do you have anything that you'd like to leave our listeners ruminating on or reflecting on between now and the next show?
Yeah, well, and thanks for having me, guys. I definitely appreciate it. And yeah, this has been an evolving thing. So I've got a good group of people now working on this stuff. So I definitely, I'm happy to share what we're doing. And I plan to more publicly too. This has been about a year-long thing, but in the big picture, I think for your listeners, and I assume it's a lot of crypto and younger as well, which is great. I think that I think the openness to price analysis will help you. I think some of the behavioral differences you can make is moving away from the common narratives in your space that may be true in the long run, but won't impact necessarily today the way everyone's thinking. And I say that from a place of experience where, once you learn about things and you're in your 20s in particular, and you see sort of the way things now you're going through a pandemic or something, right? Whether it's the GFC, whether it's the .com, and you see how, the Fed operates or how money gets, frankly, put in places that often don't need it and things like that. You want to absorb that, but you want to build inside. Like I think back to my story of my friend who had done so well. All of these things are part of it, and I just think that's it. I mean, I see sometimes the common narratives of like, okay, the Fed is printing and the whole thing's going to come down, maybe, but at the same time, there's opportunity elsewhere. And I would say that I definitely, as for every time I thought I kind of knew it all, whether it was mid-20s, late 20s, early 30s, something like that, there's always something that comes along and changes your view. So challenge those assumptions. Like I really nowadays challenge valuation as an assumption, when there's so much liquidity. Challenge those things and you'll find those opportunities, because although you may have the real narratives right, and we know the real problems in the financial systems globally, we know the inequality, and we know you still we'll see a lot of things happen between now and then in your life. And there's a lot of things you can do in the face of that and still benefit, because you have that knowledge.
Amazing wisdom with Arun Chopra over at Fusion Point Capital. Thank you so much. Adrian, thank you so much for being on. And my friends, that is the Nest Show.
Beaksy is an easy-to-use cryptocurrency exchange. Get verified in minutes. Buy and sell popular cryptocurrencies on a safe, compliant, insured U.S. exchange. Enjoy everything you need in one place. A two-way ramp for major currencies, credit and debit card support, an industry-leading API, responsive customer support, and a 5-star mobile app. Love your primary cryptocurrency exchange? If not, make the switch to Beaksy today. Visit Beaksy by clicking the link in the description.
I'd like to thank our listeners for joining this episode of The Nest Show. We invite you to connect with our guest on Twitter, where Arun can be reached at FusionPT Capital. Of course, Adrian is at CryptoBirb, and I am at BenjaminT1717. Additionally, make sure you visit Arun's project at FusionPointCapital.com to learn more about what his algo and service suite can do for your trading. Again, we want to thank our sponsors at Prime XBT for their support of the show and for their support of our listeners. Once again, after signing up to trade at thebirbnest.com/PrimeXBT, be sure to follow up on the announcement channel of our Discord and learn how to capitalize on their generous trading bonus offer that they've exclusively made available to our community. If you've appreciated the depth and breadth of what you've heard with us today, subscribe to our podcast and find our landing page at thebirbnest.com. We have a vibrant Discord community which acts as our central hub of operations, and we welcome you to join us at thebirbnest.com/Discord. We also offer an extensive free bulletin on emerging crypto market trends, exclusive undervalued gem reports, and in-depth expert technical and fundamental analysis at thebirbnest.com/bulletin. We always appreciate engagement from our community, which of course means liking the video and subscribing to our page, where we insist on bringing you the highest quality content available. Also, we're happy to incorporate tips and topics from our listeners and encourage you to email us at thenestshow@thebirbnest.com. This podcast is brought to you by the Birb Nest. Thank you, and trade on.